Yep.
Great.
We can. Thank you very much.
Great. So yeah, obviously I'm on the field, part of Corporate Hill Wealth Management. I'm Nathan Poole, Ross Brooke.
Yeah, well, as Helen says, I've worked for a firm of accountants, and we basically work with dental clients. I think most of our clients are dentists. We do a few favors for friends, but other than that, we just work with dentists. So.
Yeah, and Nathan and I work closely together on mutual clients as well. So that's kind of the reasoning for this presentation, I guess.
Yeah.
And kind of the agenda is obviously there'll be an introduction slightly. Why start early on this process in regards to selling a practice? The power of collaboration between accountant and financial advisor, financial planner, extracting non-business assets from the company prior to sale, improving EBITDA, share structuring, how much is enough, legacy and wealth transfer, post-sale strategy, and then a summary. Okay. So initially, kind of who we are, because we've kind of touched on that, and what we do. Obviously, I'm more of the planning side, so looking at working with Nathan to extract capital from the company and structure that in a tax efficient way, but ultimately getting plans started early so we can look at almost like a financial freedom date, but also to make sure that aligns up with you selling your practice effectively, and understanding how much is enough really is kind of the question I ask. And Nathan will come at that from a different standpoint really.
Yeah, so we work with a lot of dentists. As I said before, most of our clients, we do the accounts, we do your tax. We work with limited companies for associates and principals. But I think we try and be a bit more proactive. I've worked for accountancy firms which are less proactive, and I know the difference kind of thing. And one of the reasons I actually started working. I had a sort of a short period when I didn't work with dentists or work with a few dentists, and I've joined a firm where it is much more proactive, and we actually help advise and a bit more use the knowledge that we get from doing your accounts and tax and actually do something with that, because you gain a lot of knowledge when you go through dentist accounts and you understand the tax and what's going on, and we like to sort of try and advise and provide something useful from that information that we've gathered. So
yeah, it's a case of you don't know what you don't know, right? So
yeah,
always educating along the way is good. So yeah, why start early? I guess Nathan can start.
So yeah, I think we just had a quick discussion beforehand, and I think it's really important to start thinking about and actually communicating with your accountant and your IFA about what your timelines are likely to be. If we think about tie-ins, if you're selling to someone who's going to want you tied in, it could be a sort of a 3 to 5 year tie-in. So if you're thinking about you want to retire at a certain date, you work that back by 3 to 5 years. And then if you're trying to make any sort of changes to your practice before, some of those things might be like 2 years before you can do that. So we're now sort of 5, 6, 7 years back already. If we want to make a change in your shares before you sold, then that might have to be finished and ready by sort of 7 years beforehand if you had a 5 year tie-in. So you kind of, when you start working it back, it actually makes sense to really start thinking about it a lot earlier than you might do. It may seem a long way away when you sort of think about when you finish dentistry, but I think you start thinking about when you work it back, the actual what you need to do. And if you want to make any changes, it's very difficult to do. Once you've decided to sell your practice, it's pretty much is what it is. There's very little you can do then. You haven't got the time to be able to make any changes.
Well,
so
Nathan, can I just interrupt and just ask you what sort of changes do you mean, like from a
I think
structural
we kind of go into
perspective?
that in a little bit,
Great.
I think, but it really depends from client to client as to what's happened. So we're kind of planning to go into that in a lot more detail, but it is until you sort of see what's happened, it's difficult to know. I mean, I think one of the things is we kind of encourage a dialogue throughout your kind of your business life. So talking to your IFA about when it doesn't just happen when you start thinking about it. You should be sort of talking from when you first meet your IFA is okay, when's the planned retirement date? And it can change, but you have an idea. You kind of start thinking about these things a lot earlier than you might do. It's not just a last minute kind of thing. It's you have these conversations throughout the career. I mean, anywhere sort of when people start getting to an age when it's on the kind of horizon. Okay, you might be thinking in the future we're as to what might happen. So we try and have these at least a regular catch up with our clients and have a conversation with them, perhaps once a year at least, when we sit down and maybe a 3 hour meeting with a client, say what's going on, with your life, what's happening, where are we, what's the future looking like at the moment, and you start building those things in, because then you can start thinking, well, let's arrange things in a tax efficient way. Let's start making things. Let's start kind of gearing up for the retirement and for the future. So it's never too early to start thinking about it and to start communicating. I think you should have a relationship with your accountant where you can discuss these sort of things and you are kind of considering them, and you can kind of start building into them into your plans, kind of thing. So if you want to make changes, if you want to optimize your EBITDA and what the balance sheet looks like, then you need time to do these changes. A lot of these things don't happen very quickly, or if it will be rushed, it might have to be rushed through, which is not great. Tax laws are quite complicated. The last thing you want to do is rush some things. It may be too late if you left it last minute. So it's kind of understanding where you are and what might need to happen.
Yeah, and reverse engineering the scenario, right? So looking at the end date, essentially, like I try and avoid the word retirement because it has negative connotations towards it, and obviously a practice sale doesn't necessarily coincide with that. So
no,
Diana will be able to attest that she's obviously sold a practice, but she's not necessarily not working slash retired. So I like to understand what the number is to be financially free. That's kind of what I say to clients. And that gives you freedom to do whatever you want. So that could be to start up a practice again, be a non-executive director, help friends, family out, whatever it may be, do charity work, but it doesn't necessarily mean you stop doing everything. And also it's a point that it doesn't need to be your identity. So even though you are a practice owner at the moment, you are a dentist, doesn't have to be your identity for your entire life, right? So we kind of look at that aspect of things as well. And it's also looking at kind of what legacy you want to leave, if any. So we have clients who want to leave quite a good legacy to their children, grandchildren. Some don't at all. They don't want to give them anything. They want to enjoy their life and make sure their kids kind of make their own way if they have kids, right? So, and what type of lifestyle do you want post sale? So do you want to be spending £200,000 a year on traveling, or do you have quite a minimal lifestyle and you only need 20,000 a year? Looking at that number is really important as well. And that's how we look at it from a financial plan, but we take everything into consideration. So it's not just a business sale, it's extracting assets from the business into your personal name and what we're doing with those, what we're doing with surplus cash in the business, and those type of aspects as well is what we focus on too.
I think one of the other things is being realistic about timelines, because you want to sell your practice when it's thriving, not when you're slowing down. You want to sell at your peak kind of thing, or just before you start to dip and before you want to sort of do less. So it's making sure it's the sale of the practice starts at the right time. So you need to be realistic about that.
That could be subject to budget changes as well, So if anything happens in budgets, you might want to happen quick if they're going to implement it in next year April, for example. That could be something to be proactive on as well. Cool. Okay, we'll move on to the next slide. So we kind of touched on it, but the power of collaboration. So Nathan and I speak kind of regularly with clients and joint meetings, because one goes with the other, frankly. It's not my way first and then Nathan second, or it's not Nathan's first, mine second. It's in conjunction with one another. You want to work with accountants and financial planners who work closely together. because
100%.
otherwise it'll be conflicting advice sometimes. You want to make sure everyone's on the same page and we're discussing plans, the benefits and negatives to each one. Nothing's all rosy. So there's always going to be positives and negatives to different types of advice. And going through them from different angles is really, really important.
Yep. And I think there's different types. So we discussed earlier, there's different types of accountants and different types of IFAs.
Yeah.
Some accountants just want to just give us your accounts, your tax. Here's your account. Here they are. I've completed them. Here's your book. Give me your books. I've completed your accounts. Your tax here next year. They don't
Yeah.
want to get involved in advisory. They're not really interested in that. They just kind of manufacturing or sets of accounts and tax, and it's just a kind of production line. And I think so. I've met them before, and I've worked with them, kind of thing, where they're accountants. Just that's what they do. It's just a production line of accounts and tax, and that's as far as they want to go. Um, it's understanding what sort of accountant you've got, and do you have an accountant who wants to collaborate with you, who wants to sort of talk to you and collaborate with your IFA as well. Some people aren't interested in it. We think we get better results because we do it. We think when we talk to the IFAs, we work with lots of different IFAs. Don't just work with Ollie, we work with lots of IFAs, and there are IFAs that interact and that you can get a good relationship with, and you then start getting good results by that close collaboration. We look at there's the reason for this is because there's a lot of crossover. For example, pension contributions are the most obvious one, where you get tax relief for your pension contributions. So, and obviously pension contributions are generally the kind of remit of an IFA. So it's understanding the tax. It has a tax benefits, and also it works with your financial plans. So when we work together for something that works well for tax relief and works well for your financial plans, it's important to have people that work together, your advisors that work together. You need someone that collaborates with you and also collaborates with your other advisors, just to get you get much better results, get much better service for our clients. We find we can do our job better if the IFA collaborates with us. And I think you probably work better if your accountant works well with you. It's just that type of working and that type of kind of environment, which is not just the kind of standard. Is your set of accounts, here's your tax here next year.
Yeah. And take your time making those decisions as well, who you engage with, is what I'd say, and do your due diligence, because not that you're getting married to the person, but it's good to have a consistent ongoing relationship as opposed to one accountant this year, another next, and so on. Same with the advisor. I always typically say you can be the best, cheapest, and quickest. There's kind of three aspects, but you can't be all three, right? So there's one aspect you may have to forego, whether it's the quickest, cheapest, or best, and that's just a decision you'll have to make. Ideally, you'd have two or the three, but if you have one of the three, I'd kind of suggest looking elsewhere. But that's typically why I say it's kind of good barometer to go off. The best won't be the cheapest. And actually the worst necessarily won't be the cheapest either, actually. So it's good to do your due diligence and take your time making a decision. Because consistency, reliability, and trusting an accountant or IFA is really important, is what I found. And yeah, if they can work together, that's even better.
And it's building relationships. You need to think that your accountant and your IFA actually care. They care about you and your business and your personal finances and your life. And so that's one of the reasons I moved out of a kind of production line accountancy firm to a firm where I wanted to actually care about my clients. I didn't want to just see a set of numbers. I wanted to work with people I care about. I wanted to sort of get to know them, what's going on in their life, and try and help them develop and just provide a financial accountant's perspective on what's going on in their life and how we can help to make their life better and give them better results in life. So it's working with finding the right people that actually want to work with you and want to provide the sort of service you want to work with, that you want and what you need, basically.
Yeah, exactly. Cool. extracting non-business assets, accountant's view.
Right. So this mainly applies if you've got a limited company, because if you've got a limited company, there can be we've seen messy limited companies, mainly from clients we've picked up too late, and they've just gone on way and just been doing whatever they've had spare money, so they've invested in, say, a property in their limited company, um, or they've done investments. So the limited company can then become complicated. So if you're selling it, what happens to these investments on the sale? So it's really that's the issue that we find, um, and it's then trying to understand, okay, what can we do with these assets? Generally, hopefully, if you worked with a good accountant who you've had a conversation with, and you haven't just been left alone to your own devices, you may not have any issues. Or if you've managed to get the good advice at some point. But it just happens. Sometimes these things happen. Sometimes you kind of end up just making decisions, and you've kind of got property, and then it becomes uncomplicated. And these things take time to sort out. So extracting the non-business assets, as we say, we've had clients with properties, we've had clients with investments. These you can sort these things out. The big issue with it is, at the moment, it's business asset disposal relief, and the fact you potentially lose that if you're not just a trading business. If you're an investment business, and then you are getting, that includes rental income. So if you're getting a portion of your income from rental, you potentially could lose your business asset disposal relief, which means that when you sell, your capital gains tax will be higher. So what we have had to do with some clients is do some business reorganizations where we've moved the property to a separate company. We've moved assets and investments, and we've actually moved assets out of a company so they can be invested. Whereas if they were sat in the company, they couldn't do anything, because if they invested them, then they would have lost the BADR. So we've actually managed to move money out of the company into a separate investment company, to create an ability to invest that money for the last sort of 10 years, and rather than just have it sat there doing nothing. So it's just being aware that if you have a company and you have done other stuff with it, you need to sort of maybe tidy up your company before you sell it. And it's better to tidy it up. A lot of stuff will then get picked up through due diligence. When the solicitors go through it, it's going to create questions. If you haven't done it in time, ideally you want to do it a few years before you sell, so the company's tidied up and absolutely clean, so that when you sell it, there's no sort of lots of questions from the solicitors and accountants saying, well, what's all this? What's this in here? Where's this come from? What's this relate to? How does this affect the business? And then it's trying to get everything done, and say properties moved out when you're under pressure is not a good thing to do. So it's better to have the time, get things done properly, sort it out, get a nice clean company, limited company with just the dental bit, just the bit you want to sell. And there might be assets you want to keep. You might have a property in there. You might have the practice property in there, and you might be thinking, actually, I want to keep that. So you could potentially move that property out, and then just sell the trade. So,
And
then
that's
rent.
where
Yeah.
pension kind of comes in as well, because you can buy the commercial property within a pension. So looking at pension contributions, and that's why it's really important to get started early, because you can look at these plans way in advance, and you can say, okay, how much do I need to have in a particular pension pot to enable to afford a building of this value, right? And then the rent from your business can be paid into the pension. It doesn't count towards your pension allowance. So it's a very tax efficient way of getting money out the company and into your personal name, basically.
Yeah. But a lot of this stuff won't be an issue if you're working with an accountant from your early stage. If you do this as you go along, you may not be in these problems. You may not have these issues. So it's working with getting the right advice at an early stage is very useful, and you don't necessarily have these issues then.
Yeah, and things change so quickly. So
Yeah.
Things can change year to year, and having the ongoing conversations, knowing your options is
Yeah.
really important, as opposed to having your mind set on something. Things can change quite quickly, given how quickly legislation changes in the UK, frankly. So you've got to be quite adaptable, like your plan does, and be open to change if it's necessary. And just, yeah, Nathan and I will kind of outline options for you and the positives and negatives of each, and then make an informed decision is the important part to move forward.
Yeah. And again, it's something like a property. It falls part of, as Ollie says, it kind of falls part of your potential income for your future. And how's that going to work? I mean, if you're planning on keeping the practice property, then as a rental income, then that will obviously affect your tax for the future, because you'll have rental income. Or if it's in a SIP, it might not cut, it might be fine, but then it's kind of building the value in the SIP. So it can it forms part of your kind of financial planning for the future. So these are things all kind of work together. So it's deciding, trying to kind of decide where you want to go, what the plan is, and then your accountant and your IFA can work together and come up with a good plan and the most tax efficient and sensible plan to make things work for you.
Yep, perfect. And this is improving EBITDA, which is more Nathan's remit than mine. So
yeah, so I think when it comes to sell, I think most people possibly heard nowadays of EBITDA. It's your earnings before your interest, taxes, depreciation, and amortization. And it tends to be the value or the ongoing value of a business. In the ongoing profitability of a business, basically. A lot of valuers would adjust the EBITDA, and you'd have an adjusted EBITDA. So that would take into account things like paying the principal as an associate, and then removing any costs that are not going to be carried forward to the new business potentially. Some valuers take a little bit more license, creative license with that. But yeah, the better values of a kind of quite a reasonable, take a reasonable view on what ongoing costs are likely to be. But we see different types of clients. Some clients really want to improve their EBITDA and actually try and maximize the value of the practice by, okay, in the last few years, let's try and get this as well, as good as it can be. And other clients, I think they're a bit more laissez-faire. It is what it is. I'm happy. I'm comfortable. I'm working as I am. I'm not interested in making any changes. And there's no right or wrong. If you want to improve your EBITDA, there are things you can potentially do. You can work with someone maybe like Elon, who could help you kind of drive the practice forward. And I think the interesting thing would be, having mentioned that costs get taken out. Alan's not paid me to say this, but the cost of using someone like Alon or any other advisors is a cost that will be added back for EBITDA, because it would be seen as not an ongoing cost. So if you are actually motivated to try and improve your EBITDA, you don't have to think, oh well, I'm going to probably spend more money. I'm going to spend more money to do it, and worry about that and how that's going to affect it. You may spend more. You may spend a bit more money, and hopefully generate more money and improve your EBITDA and actually make things work better. But the actual cost of taking that advice is not a cost that would go through the EBITDA. That would be added back.
I just add something. I mean, actually, yeah, you make a very good point. One of the things I find really important from this aspect is actually working out whether the practice has a significant associate-led EBITDA, because then that will determine what kind of buyer is likely to be. So whether it's going to be a multi-practice operator, whether it's going to be a single operator. And that, and that will then actually have effect in terms of thinking about how you want to reduce. What was the word you used? Not retire, but how how you want to exit and how you want to
Yeah.
drop down. And so it's a really important.
Yeah.
It's a really important fact, and whether it's realistic to actually, to implement, what sort of change is realistic to say
Yeah.
to boost it, or whether you can actually change a different type of buyer
Yes.
by really transforming the practice.
Exactly. And I'm working with a client at the moment who's doing something similar. They've actually they are reducing their level of input and increasing the associate level of input, which isn't going to improve the EBITDA because they will be their earnings are less. So it's the associates don't earn at the same level as they are. But the plan is that when they sell, their commitment going forward is going to be less. And that's their motivation. And every person is different as to what they want to do. They at the moment they want to work as long as they can and sell and not have a huge commitment once an ongoing commitment. So that works for them actually to start reducing their input to the practice, passing over more to associates, building up the associates to do more work, trying to make them more efficient. But it's not necessarily going to increase your EBITDA, but it might be what works for you. So it's kind of looking at these sorts of, it's not just about improving your EBITDA, it's kind of understanding the practice and where you want to go and how you want to exit. But there are things that you can do. There are things that we've seen practices do before. You can start looking at your costs. You can start cleaning up any expenses if there's stuff going through it doesn't need to go through. You can get so many direct debits and standing orders for stuff that actually is not needed anymore. You can look at your contracts. I think a lot of people have looked at their electricity and gas contracts over the last few years, and there've been a few issues with those. And some people have been stuck on very high fixed contracts, and they've now fortunately coming off them. But it's trying to sort of look at what can we do? How can we streamline this? How can we make this a bit better? Making sure your team is as streamlined as possible. Making sure that that it's just that kind of looking after the expenses fund and obviously driving the income. Can you drive your income up in the last few years? Are you kind of putting in how much effort are you putting into marketing? It can be very easy as a dentist to become a bit complacent and you don't need to do much. You're comfortable. So you can potentially there are options for driving your income up and getting a bit improving your EBITDA. As the slide says, you want to present a strong and sustainable profit history to the buyer. So it's doing it last minute doesn't particularly work well. It's kind of what does it look like? The valuers do tend to look at the latest figures and try and present the best possible position. So if you are kind of increasing your profit, then that's good. But is it sustainable? Especially if you're being tied in, can you keep that going in the future? And it's alignment of the business performance and personal goals, and that's kind of another way part where we cross over. It's kind of making sure, as I said, it's the alignment. When I talk about the alignment, the client that wants to sell up and not have a huge commitment. They want to be the practice owner for as long as possible. They don't want to just sell and then be committed into a practice which has been their baby for a long time. They've built it up, they've developed it, and it's been something that they've owned and controlled and looked after and developed in many ways, kind of thing. And it's not something that they want. A lot of people don't feel they can work for someone else in their practice that they've created and developed. So if that is what works for you, then it's kind of making sure that we can align with that, and try and get the best result for you. I think this is about measuring the key metrics. So there's a famous saying that whatever gets measured gets managed. So it's looking at your management accounts. we work with a lot of clients, and you look at monthly management accounts, and a lot of clients not particularly comfortable looking at numbers, accounts numbers, but it's something that if you do, you start to see the numbers and start to see the patterns and start understanding what it means. And there's only one way of doing that, is actually looking at it, or working with someone who does understand it, and they can kind of tell you what they see when they look at it. So that's what we do with some clients. We work with them and we say, look, this is what we see when we look at your management accounts. These are the numbers, these are the metrics that we're looking at, and what we can see things how things are going. These are the anomalies we see. These are the things that are worrying us. These are the trends. This is where things seem to be going. So um, start using the measures, not just your accounts, but there's other metrics within the practice software that you can use to kind of measure and keep an eye on the practice. So, and then that you can use that to help improve your EBITDA. So as it says on the slide, the higher EBITDA, the higher sale value. And then obviously that gives you a lot more money to play with in your exit strategy and your retirement, even though we don't like that word. So yeah, it's understanding that it all kind of links in together, and it's how we can kind of put those things and these options together, what you can do. But yeah, it's not necessarily going to be, you're not going to necessarily make huge amounts of changes. Some people are happy, it is what it is. We will just walk into it, we'll go, but it's then understanding that this is what it is, this is where we're going. So you can kind of have your valuation, and we like to get our clients to have a valuation early, so that they start having an idea. Okay, this is what the practice looks like it's worth at the moment, and then that would help Ollie with his kind of figures, and so he can start thinking, well, okay, well, if you're going to sell the practice in 5 years' time for around this amount of money, then we can kind of factor that into the plans.
Yeah. And it's typically one of those things, you get good at what you focus on. So if you
Yeah,
don't focus on improving the EBITDA, it won't be as profitable, or you won't sell it for as a higher value as you would if you focus on it a bit more.
yeah.
That's typically just in life in general, really.
Mm.
Cool. And then share structuring. There's obviously two
Yeah,
viewpoints.
so there are things that can be done with shares. It obviously depends what your starting point is, and it depends what your personal situation is. We mentioned here transferring shares to a spouse or a partner. Obviously, with a dental business, and especially a limited company, then you have to have a majority of directors that are GDC aligned. So if your partner's nothing to do with dentistry, they can't necessarily be a director, but they could be a company secretary, and they can own shares. They can own 50% of the shares or more, and then you can potentially use CGT allowances um, to kind of make things more tax efficient. We obviously got a budget coming up, so we'll have to see what happens there, and find out what changes come from that. But there's normally a benefit to everything not being in one person's name. How much that benefit will depend on the value of the practice, and yeah, let's see what the current allowances are with HMRC at the time. And some of these changes, if you were to make a change, I think that's the other thing about getting this sorted early, is that you have to be own the shares for 2 years. So it's starting to make these kind of think about these things early, so that you can actually get the ownership period sorted 2 years before you sell, um, to make sure you are kind of trying to maximize or make the tax efficiency of the strategy kind of thing. So it's kind of understanding that there are things you can do with shares. Depends on the timing and depends what your situation is. It all really there are so many things that can happen. It's a lot easier to do early on. We do a lot more share structuring at the formation of limited companies, when we try and plan things in advance, and when we say, well, actually, in 5 years' time, we maybe want to have your kids as shareholders, so let's put them in now before the company has any value. Because when you start transferring things over and it's got value, then it becomes more complicated. So working with an accountant from day one who can actually say, well, yeah, maybe in 20 years' time, you might want to have this. You might want to have these opportunities. But yeah, there's long-term planning, and but there's still some things you can do in the short term, but you need at least sort of say 2 years to think
Yep.
of having fixed it.
And it's also, Nathan, around, do you have another company which has investment property in? Do you want to pass those down to the children?
Yeah,
As well, structuring that so they have access to the capital, but you have access to the income, post
yeah,
financial freedom, stuff like that is really important as well, just to consider.
yeah.
And we will look at all in conjunction. Do you want to pass the practice down to children as well? That's something to consider. If they're dentists, depends on obviously age, experience, so on, and if we think they're up to it. But they're all conversations to have, and a lot of the answers, I guess, on presentation.
So
Yes, I think
yeah, so one
Ollie
thing I was going
froze.
to say while Ollie's kind of dropped out a second, is one of the things we can do with share structuring is when is a lot of our clients, once they've sold, they set up an associate limited company. So if they've got a tie-in for a few years, you can set up a brand new company, and with that, you're able to set up new shareholders. Quite a lot of our clients have maybe children who are going through university, and they want them to be shareholders, so we can set those up, and that can be tax efficient as well. But that at that point when you've just sold your practice and you've just still got another 2 years or so or 3 years of working, it can be quite efficient to make those sort of changes then. And then, as Ollie says, you can then use that company for estate planning and wealth transfer strategies, um, to actually pass that wealth on within the associate limited company.
Mhm.
Which
Yeah.
So the associate limited company can effectively become a kind of a family investment company.
And then, yeah, how much is enough? So this
Yeah, so
is a quite
it's
a kind of big point, actually.
yes.
So from a financial planning perspective, we would go through a cash flow model with clients in quite a lot of
Mm,
detail, reverse engineer that and stress test that against, okay, what are you going to do with the proceeds? Would part of it be to pay off the mortgage? Would part of it be passed down to children? And what kind of income would you require post sale?
yeah.
If all those things were done, what is the minimum amount you need? We would look at that, and we'd look at the investment strategy around that. What type of capacity for loss you have which is important, and the required rate of return on the investments. So do you need to have at least a growth rate of 4 or 5% on the investments per year, which is stress tested against a loss every 8 years? We typically do based on historical data. And what risk are you taking? The higher the risk you're taking, the likelihood is the drop when the markets crash will be higher, given the equity content. This is how we'll stress test that and understand the underlying number. What is the minimum you require from the sale to be financially free, which is the term I use. And you can kind of hopefully do what you want with your life without having to think about the monetary side of things.
Yeah.
And that's what, from our point of view, that's where it's focused on, is the cash flow model, and doing it as soon as possible, reverse engineering the strategy and aiming for a particular number. If you get more than that, then great, we can do additional planning. If it's less than that, how do we bridge the gap? What do we need to do in order to get to that number? Are you going to be financially free earlier? So say, for example, if your plans change from 60 to 65, what would that look like? What would the plans be like? And what would that number be? Because that obviously will be different compared to 55 to 50. And we work on very conservative bases as well. So you can't turn around in 20, 30 years' time saying you said this number will be okay. So typically clients are better off than we expect them to be, or we project them to be, but that's the best way to be, rather than thinking you've got enough and you don't.
I think I've worked with some clients who hadn't taken financial planning advice and had been sort of slowly kind of putting money away in a pension, but not really understanding the sort of difference between just someone who sells you a pension and someone who does some financial planning. And it can be massively freeing and a massive weight off your chest, that when you actually know this is what's going to look like. And actually, one of our clients was suddenly, it found it very freeing when we realized they were going to be all right. Had a pretty comfortable future, and it was all planned out. And when they see that kind of put into numbers, and when Ollie kind of demonstrates, this is what it's going to look like, this is how you're going to live, this is what you need to live on, this is how much income you're going to get, and this is where you're going to get it from. This is going to come from your pension. This is going to come from here. And it's I've sat in some of these meetings, and it's very interesting to see when it's presented of how things are going to work for you. And I think some of the I've sat in quite a few of these sort of meetings, and it's very interesting, and it can be very useful to know exactly what it's going to look like, and how it's going to work for you.
Yeah, and understanding how what your decumulation strategy is what we say as financial planners typically.
Yep.
So are you going to have all your money invested and just withdraw that ad hoc, or on a regular basis, regardless of the markets, which I always suggest not doing, because if you invest the entirety of the capital and that goes down by 20% in a given year, that can impact your actual retirement by up to 40%, depending on the value, really. But it's a massive change. So having a sensible decumulation strategy, we work with like pot approaches, we call them. So you have short-term pot, which is basically cash or cash equivalent assets of like 2 years of expenditure. Just because if the markets drop, historically, it's taken no more than 2 years to recover back to where it was before. So you don't have to liquidate the losses, we call them in the investment side, in those 2 years. And then once the markets are recovered, we will rebalance the buckets on the bucket approach. And then there's a kind of a 2 to 5 year pot, which is still low risk. It's depends on your risk appetite, frankly, but there it comes again, it depends. But there's a 2 to 5 year pot, which is still low risk, a medium term pot, which is like 5 to 10 years, which is your personal risk appetite. Then a long term pot, which can have it can be 10 years plus of investment time horizon, which is slightly higher risk than your actual risk appetite. But the overall pot is likened to your risk appetite. It's just different strategies for different investment time horizons, which is extremely sensible, rather than just having one investment approach. And then for each investment pot, you want to look at your investment return for the risk it's taking. So these have terms like alpha, Sharpe ratios behind the scenes, which is getting into the detail. But these are really important because you can have a really good return, but you're taking extreme risk, right? So if the markets go to pots, which it can do given has been going on in the world for like the last 5 years, you want to protect the downside because you've done the hard work. Most people can't save enough to be financially free, frankly, in the UK, right? So you've done the hard work, protect the downside, and make sure you've got the right risk-adjusted return, the right decumulation strategy, to protect your hard work effectively.
So one of the things the way sometimes we work in collaboration with the IFA at this point is there are things like if we have a kind of a strategy that works together. For example, if you had money in a company, we could be looking at thinking, well, we could drip feed dividends out of the company for the next 20 years. That might work if your income is going to be basic rate band and we're taking them 8.75%.
Yeah.
Or we could close the company now and try and take the money out now. Or we could be thinking, actually, the money in the company is going to go to the kids.
Yeah.
And so it's understanding. So there's a crossover between the accountant, what the accountant can do, and the tax advice and the strategy from the IFA and the financial planner, and how it's all gonna fit together. So it's kind of combining the different inputs from your accountant and your IFA, and that gets you better results. Is basically what we're trying to say, is that if you work with them, there's two different aspects to it. There's your tax aspect, there's your wealth aspect, and you kind of work together to try and get better results, rather than having two people just doing their own thing and not really communicating.
And this obviously changes year to year. One year you may
Yeah.
spend more than what we've assumed in a given year, but markets have done really well, so you withdraw more from your investments. It's super flexible, and that's the beauty of it. And yeah, you're not set in stone. You're not saying, okay, you're going to spend 30,000 this year, and we're holding you to account. It's very flexible. It depends on how your objectives and wants in life change, which, as anyone knows, can change very, very quickly and very frequently, given life events, be it personally, friends, family, whatever it may be. Things do change quickly. Cool. Yeah, legacy and wealth transfer.
Yeah, I think I've touched on some of this already. So we talked about the sales structure, how what works best for the sale. But it's what we do with the post-sale assets. And so you're going to have a pot of money from the sale. Hopefully you sold your shares, you pot of money. Hopefully that's gone to you. You've paid your capital gains tax. And then it's how does that work for you? Do you need that money? Do you need all of it? Perhaps you want to sort of help your kids out, get them on the housing ladder. So it's starting to think, okay, how can we do that tax efficiently? What's the best way of doing that? Which money should I be using? I've got my associate income. Should I be using my associate income, or should I be using this pot of wealth that I've just got from selling my practice? What's the best way of doing it? And it's looking at, okay, these are the plans. These are what we want to do. We need to pay for this wedding, or we need to pay for this house, or we want to give some money and help our kids out. How are we going to do that? Plus have enough money to live on in the future, and do it in a tax efficient way. So we can kind of work together. You can find best ways of gifting money, or do some inheritance tax planning within a company or a family investment company. So there's different options, and it's just, yeah, there's a big crossover is basically the main message we're saying at the moment is where you're at IFA, it's better to take advice, but taking collaborative advice is even better.
Yeah, and I actually have a lot of clients who have almost like an identity crisis post either a business sale or actually stopping work. Right, they don't know what to do with the day to day. They've had such a structured life for 20, 30, 40 years, whatever it may be. And then they stop and like, it's Monday morning. I have no idea what I'm going to do with my week. Some people do not have that issue at all, but actually having a conversation with a client, like, what are you actually up to this week? Are you doing anything meaningful? Do you still have like a meaning in life that actually gets you out of bed in the morning? Which that could be bridge, it could be picking up the piano, like actually like trying to learn something new, which you've put off because you've been so busy running a practice. Like, these are like really important questions to ask, and it can be as simple as when the business has been sold, is literally getting calendar out and trying to fill your diary initially with things you probably won't be interested.
We lost Ollie again.
Yes.
Yeah. So it's a very interesting time of life. It's a very interesting time of life for people. It's quite an exciting time where you have this kind of this big build up. You kind of sell your practice, and then it's what comes after. And I think that is as Ollie said, it's very important that you kind of think about what you want to do and what you need, and hopefully that you've got enough money that enables you to kind of do some more of the things that you really want to do in life, and whatever that might be. But
Right, I think I'm back, Nathan.
okay. All right, I'll stop filling for you.
yeah, exactly. I was in the middle of a rant, but yeah, basically it's trying to find a meaning in life post business sale is important. And as Nathan was saying, I did get a bit of it. It is an exciting time. It should be something you should be excited about, and hopefully you can get excited about meetings with Nathan and I, or your accountant and advisor around what you can do. It should be an exciting time of life,
It
really,
is.
rather than something to get kind of bogged down by. You've
Yeah.
achieved your financial freedom goal, which most people want to achieve, frankly.
Yeah.
Cool. Post-sale strategy, this kind of leads on to this as well, which is
Yeah, so I think we've talked about using an associate company to manage your to manage your associate pay afterwards. If you've already got money out of the company and it's taxed, is it most efficient to use that money and then keep the because obviously if you have a limited company, you get taxed on the money you take out of it. So you could build up wealth in a limited company and pay the least amount of tax by leaving it in there. That's just one strategy we do with our clients. Um, so but then it's kind of understanding that's the plan. This is how it's going to work. Ollie needs to know that he's not investing that money. He needs to know that you're going to live off some of that money.
yeah.
So it's kind of understanding how that works, and how they're kind of going to affect the strategy going forward.
Yeah, and then we can build investment portfolios around that as well to suit your withdrawals or
Yeah.
income you require. So, yeah, it's a good thing to know ahead of time, and we can be pretty flexible on that strategy as well. And yeah, manage withdrawals to reduce the tax liability, which is kind of what Nathan said as well. Yeah, use the business proceeds to fund lifestyle. Nathan's touched on that as well. And yeah, I've touched on this earlier, but your decumulation strategy regarding like your investments, what you should have in cash, what you should have in like cash or cash equivalent assets versus low risk investments, medium risk, and higher risk relative to your actual risk appetite. But understanding like your capacity for loss as well is really important. So, what can those investments go down by, and you still be okay? And also, what can you increase your expenditure by and still be fine, and not run out of money? Frankly, perfect. So
Yeah, I
that's
have to say, I think what having I don't do anything like what Ollie does, but I've sat in meetings when financial planners kind of go through this with their clients, go through the plan, and I think it's fascinating to see how it all fits together. It's this is how it's going to work. This is how your life is going to look like, and this is where the money's going to come from. And this is what it could look like for you, and this is if you need to sell your house, when might you need to sell the house? If you might not need to sell the house, or how it's all going to work, and this is how you can give money to your children, and this is it. As a numbers person, I find it fascinating. I quite easily geek out on it, but
yeah.
it's interesting stuff. And it's most of the clients I think that I've seen that've gone through the process, they find it very valuable, and it's a real kind of real benefit to them, real weight off their chest kind of thing, and actually having clarity as to what's going to be happening and how things are going to look is really worth doing.
And actually, a lot of advisors don't do it.
Mm.
So it's the same with like we mentioned at the start. Like finding a good accountant, a good advisor is that fits your needs. Importantly,
Yeah.
is really important actually, and that kind of brings us to a conclusion. But yeah, in summary, start early, collaboration matters, optimizing value regarding EBITDA for sale if you want to, if that's what you wish to do. Extracting non-business assets, really important during its working life.
Yeah.
Post-sale strategy regarding decumulation
Yeah.
and why it matters. So yeah, it's not a business transaction really. It's a life event, frankly.
Yeah.
And
I think
hopefully,
it's finding advisors that I think you want to work with, and you can actually they work together and collaborate, and can actually give a kind of a much better solution, or a much better kind of uh, results for you. I think if you work with people who work together and who actually know how to kind of collaborate, and
yeah,
know how to kind of work with a strategy for you, with you and with your other advisors. I think you need to uh, have
you've got
advisors in your life that you actually trust and you want to work with. And I appreciate that not all accountants are the most interesting people in life, but you don't have to. If you're stuck with the wrong one, just try and find a good one.
Yeah. Also, two brains rather than one helps.
Yeah,
So
definitely.
I don't
And I
know
think
what
that
Nathan
that is
knows.
really important, actually.
Yeah.
I think they're really
Yeah.
important that actually, that if you've got your accountant and they are kind of listening to your IFA's advice, even if you don't feel comfortable and you think, well, I don't know if this IFA is telling me what the right thing or not. Can I trust them? Can I trust what they're saying? If you've got an accountant who knows a little bit as well, and
Hmm.
they're saying, well, yeah, no, what your IFA says makes sense.
Hmm.
And same for you. Same for IFA can say, no, your accountant is making sense. This makes sense.
Yeah.
So when you've got that kind of additional kind of backup, if you are a bit worried about whether you're kind of taking advice from people from like an IFA, if you have a kind of collaborative environment, you've got that additional backup where the accountant is also evaluating what people are saying and the IFA is evaluating what the accountant's saying. Does it make sense?
Yeah.
And you have that kind of um, additional kind of resilience in the advice you've got because you're
Yeah.
having more than one opinion and more kind of it's not just all separated.
Yeah. Yeah. What Nathan said. Yeah. So that's everything. Our contact details are here. If you want to jot them down, you can get in touch with us directly as well. So, but if there's any questions, now is kind of the time to ask, or you can reach out separately after, whatever's kind of best for you guys.
Great. Thank you so much, Ollie and Nathan. That was a great overview. And as said, if anyone has questions, please come up and sort of ask any questions, either say hello or drop them in the chat. I was going to ask Nathan, what would be like the biggest thing, I guess, biggest sort of accounting mistake that people make, or from the structural make when they sell their practice? You know, what's kind of the number one or the top two things? It's like, yeah, you have to make sure you've got this particular thing sorted out.
um that's a good question. I see so many different things that come through. Generally we like to think that our clients don't make mistakes
Yeah,
because we've been working with
of
them for a
course,
long
yes.
time.
Other
So
people's clients.
so by the time we've picked up, I think it's mainly coming too late. We find people come to us too late.
Yeah.
And we sometimes get referrals from people saying, I've got this guy, he's selling, can you help him out? And we're picking up thinking, well, we wish you had you 10 years ago. Then we could have done something. But we've literally, you've already agreed the sale. I can't help you much now. It is
Yeah.
what it is. There's nothing we can do. We can't really do anything. Uh, Apart from maybe the after sale process, and we can help with that, and that's what we have done with some clients is say, okay, well let's at least focus on the after sale strategy, get that right. But there's lots of little
Yes.
things that but yeah, it's tidying things up. We've seen people selling their practice with a lot of money left in the business.
Yeah.
And that can be a bit of an issue. Quite a lot of people, as I mentioned before, that if you are taking money out of the business, out of a limited company, then that is obviously taxable. So some people have the strategy of leaving the money in the company.
Yeah.
Then the more money you leave in the company, puts the business asset disposal relief at risk because does the company become an investment company?
Okay, from when you sell, you mean when you sell the
When you
shares?
sell the shares, is it an
Yeah.
investment company? And then you potentially lose the business
Yeah.
asset disposal relief.
Yeah.
There are things you can do.
Yeah.
There might be a reason you got the money, and
Yeah.
there might be perfectly normal reasons, and it might be a perfectly acceptable amount of money to have.
Yeah.
And it depends what you're doing with the money. Are you earning money? Are you earning interest from that money, and how much interest are you earning?
Okay. Yeah.
So that's a risk, a big risk.
Uh, Great.
Planning on what you're going to do with that money is important.
Yeah. Ollie, kind of, I guess I was going to ask, I guess, similar kind of question, but on your side of things, in terms of what are the kind of biggest hiccups you see that people have when they've made their plan of how much they need every year, and they've got their everything, they came to you very early, everything's lined up, and in all the different pots. But as you said, stuff happens in life, and kind of post sale. What are the sort of things that change people's plan the most?
Divorce can, frankly. Divorce is a big one. So they're not as rich as they thought they were, because their partner's got half now, or something like that.
Yes.
And then they've got to taper down their. It's not like a recommendation is not to get divorced. It's quite expensive, basically. but that is a big factor, to be honest. Like, that's happened a couple of times, and that is just drastic. You've got to almost say, look, you can't afford to live. It depends on the circumstances, as I've said throughout this presentation. But sometimes it's a case of you need to either go back to work, find additional work, or reduce your lifestyle expectation, which aren't easy conversations to have. That's one that you can't control to a point, because it doesn't have to be your fault necessarily. It's just the other person's decided enough is enough. So, but outside of that, it's just the investment strategy is really, really important, I would say. It depends. With dentists, a lot of them have like NHS pensions. They have a guaranteed form of income. It's understanding actually, what investments we're in and how much is being invested. What kind of cash buffer do we have? That's the important part. As I kind of mentioned in the presentation, if those funds do go down by 30, 40%, maybe not that extreme, but 20%, if they're fairly high risk, and that can have a detrimental impact if you then have to withdraw income from that depreciated asset. That's a massive impact. So, okay, that you can't leave the legacy you wanted to leave. So having a super tight plan, which is airtight and watertight, it takes a lot of planning, and it's actually you probably get more value from a financial planner post sale, definitely. But financial planners basically don't make that much money from dentists, frankly, before sale. But it's really important for us to be involved in that process throughout it. So we're ready for the decumulation side post sale, and we can have a proper strategy around that, working with people like Nathan as well. And if you have found an advisor who's not interested in getting engaged in that, it's probably the wrong advisor. You want a long-term relationship, and that's where you build trust as a financial planner. Actually, is happy to give free advice to build trust and build a relationship, because it's hopefully a long, fruitful relationship for everyone, right? But again, Nathan's kind of hit the nail on the head. It's not getting started early. Like a lot of people, it's different if you own a practice, but if you're just working and you just live beyond your means effectively, and they come to you too late, I want to retire in 10 years, I want £100,000 a year of income, and I've only got 100,000 invested. That's a tough conversation to have. Like, you've got to bring them back down to reality. But the clients who have been the most successful during my career are people who have got started early, and compound interest works for them. As they say, kind of compound interest is the eighth wonder of the world. It either works for or against you, depending on what side of the fence you're on. If you start early, the more powerful compound interest is. And that's where leaving legacy to kids actually is really important. If you can start saving for kids early as well. Life is pretty tough for like the younger generation. What is it, Gen Z now? What do they call it? Getting onto the housing ladder's the most unaffordable it's ever been. So if you are in a position to do so to help kids out, it's good to get started early, because I only see things getting kind of more difficult. But that's a different conversation for a different day, I guess.
I think one other thing we should mention. I think you do protection as well.
Yeah.
Making sure you're protected.
Yeah,
that's the biggest mistake that I've seen, is that making sure you're not being protected. I had a client who we'd just taken on, and unfortunately and tragically he died. Literally, I'd met him, and then 3 days later or so, he died, and he didn't have the protection in place that he should have. If it was on the list of things to do that we were going to address, it tragically died before we could do anything. And so, yeah, making sure you just got your protection insurances in place, and everything is someone's reviewed that, and it's at the right levels to give your spouse and your kids the future they need, whilst you may not be selling right at the moment, but just making sure that those things are in place, because that's
you can have the best plan in the world, can't you? But if something
Yes.
tragic happens, then it's kind of not wasted time, but it can be avoided as well.
Right.
So putting a price on protecting your family and plan is kind of invaluable to a point.
Definitely.
So
we don't like to think about dying, but we are all
we've
mortal.
got to.
So
yes. Well, on that cheerful note,
exactly.
I guess it was a very clear point. Make sure you've got it all in place. But I'd just like to thank you, Nathan and Ollie, for your presentation, for your time, for joining us. Thank you so much, and have a great evening, everyone.
Thank you.
Perfect.
Thanks
Everyone. Thank you.
Bye.
Thanks, Ollie.
Cheers.
Cheers.